What's up, Chiefs? It's your boy Lube of Wall Street. What's going on? My channel is about serious investing and it's jacked with lube. So you may ask, what the fuck is lube? I mean, I think you should know better. If not, just know that it's simple, smooth, and jacked with goose. Okay, enough BS, let's jump right in. Today we're gonna talk about inflation in light of the April CPI data that came out earlier this week. More specifically, what does the April CPI data really means? What is the forward-looking trend of inflation? Why you should be concerned and what you should be doing as investors, especially as a retail investor, just like myself. First, let's look at the news. CPI came out meaningfully above expectation earlier this week. And we also saw a lot of catchy headlines like this one by CNBC. Is it really this much of a shock? In order to digest a highly visible news like this, we need to put things into perspectives. These estimates Dow Jones put together by surveying a bunch of economists are fucking jokes sometimes. I believe most of them came up with their estimates in rather arbitrary fashions. And you probably agree with me if you follow these indicator releases regularly. Number 2, you should take into account the transitory factor of easy comparison versus weak inflation of April last year. Let's just look at the data. Core CPI was about 1.4% last year. Assuming 2% is the targeted norm, this means we have about 0.6% easy comparison year over year. Given these, the core CPI this April is more like 2.4%, which is not that shocking. Number 3, the truth is any positive shock in inflation shouldn't come as a surprise to you, as evidence in inflation pressure has literally shown up everywhere. Well, I guess everywhere except in the official inflation data, ironically. We heard it from anecdotes, friends, forward-looking data, and even on the fucking news. And my massage parlor girl is jacking up prices, citing inflation pressure. So the takeaway here is that the data shouldn't come as a shock to anyone at all. As we saw this week, there was some initial shock to the equity market, but it quickly bounced back in the next few days. While the data itself is not a shock, I believe inflation will inevitably continue rising and probably surpass current market expectations. Reasons are, on the demand side, spending growth is skyrocketing in light of rising household income thanks to stimulus checks and pent-up demand into continuous reopening. Our best friend Uncle Powell will also keep monetary policy super easy under his new average inflation targeting scheme. At the same time, I also don't think the US government will be winding down their aggressive fiscal support anytime soon, because it is almost free, it supports economic growth, and most importantly, it could effectively deal with the inequality issues which have been widening for decades. On the supply side, we have already seen a lot of signs of capacity constraints. For example, we already saw this in many commodities whose prices have gone up a lot. Also keep in mind, new capacity for some commodities, especially industrial metals, will take years to come online. At the same time, labor growth is not catching up with demand growth, for many reasons I don't have time to explain here, but you can see this from the recent non-farm payroll data in April. At the same time, employers are actually making workers work longer hours, as seen in the data, which will eventually turn into higher wages, hopefully. Okay, given all these, why should you be concerned about inflation? The answer is simple. Inflation eventually leads to higher long-term interest rate, thus, higher discount rate for financial assets like stocks. This means lower asset prices. Just to be a little nerdy here, the impact of inflation on long-term interest rate happens through 2 channels. Number 1, higher inflation will pressure Fed to raise interest rate faster and sooner, which will flow to long-term interest rate through rises in forward interest rates. Number 2, higher inflation simply means the creditor will demand higher interest rate payment in order to protect their purchasing powers. So here comes the most important question. What we could do as investors? To be 100% clear, I'm not saying you should go and sell all your stocks, because inflation actually also have a positive growth implication on stocks. In fact, I personally think there is still some runway in the US stock market, which I will explain in another video. And I personally still have a meaningful amount of growth stocks at the moment. So what I'm really trying to say is, as investors who own a lot of stocks, we need to have inflation hedges in our portfolios, which means the assets that will do well when inflation rises above market expectations. Here are a few options you can do. Number 1, buy commodity futures if your accounts can trade those. I personally really like future as it can give you a lot of leverage. And believe it or not, leverage is actually a good thing when you are using it to hedge or diversify your portfolio. You may ask, a lot of commodities have done super well this year. Am I too late to the game now? My short answer is fucking no. If you look at how the commodity price curves evolve, you will see most of the rise are led by increases on the short end of the curves. To some extent, the gains in commodities so far has been driven by real physical demand instead of speculative activities. So commodities, especially those with inelastic supply, still have some runway to go. And my favorite is copper. In the near term, copper benefits from the revived home building booms. In the long term, copper benefits from secular trends like electric vehicle adoption and new energy infrastructure build-outs. Because all the wires transmissions are copper, there is also meaningful amount of copper in EV batteries. On the supply side, it still takes 5 to 7 years for a new copper mine to come online. Given all these, I have all-in copper futures. With diamond highs, obviously, no way back, no questions asked. Well, though the truth is I have been paying margin cost this week because this week is not the best week for copper, and I still need to figure out a way to pay for my margin cost on Monday. So absolutely G fucking G. Second option, you can also short bond futures given the positive relationship between inflation and nominal bond yield. And if you're really fancy and want pure exposure, you can also buy the inflation-linked bonds and short the nominal bonds, while keeping dollar duration neutral. Well, it seems so far these options may not be too friendly to retail investors. Don't worry, I think the following ones will be better. Next, you can just buy commodity ETFs. For example, as I listed here, SLV for silver, GLD for gold, CPER for copper, DBB, DBC, GSG for diversified commodities. I'm sure you can find a bunch of oil ETFs, but I personally don't like oil as an investment at this point, so go find them yourself. Among these ETFs, I like SLV, or I like silver. Silver has industrial usage, it has exposure to high-tech, green economy, and most importantly, the precious metal wealth preservation attribute. I mean, as we all know, it could also go to the moon in light of silver squeeze. Guess we shall see. Next option, you can just invest in stocks of miners. I have listed down just a few as examples for you. I'm sure you can find a lot more yourself. Pros for these miners could do really well in industrial metal upcycles. Cons, by investing in them, you're also exposed to their operational risks. To be honest, based on my prior equity hedge fund experience, the operational track record of these miners is definitely not the greatest, so please do your own fundamental research before investing in any of them. Next, you probably see this a lot, you can also just buy inflation protection ETFs, like TIP. They look pretty good on paper, these are pretty conservative and they offer inflation hedges. However, if you have a lot of growth stock like me, it may not be the best option for hedging in light of the intrinsically low volatility of these products. Because lower the volatility, less effective the hedging will be, which hopefully I will explain in another video. Last but not the least, cryptocurrencies. Most of the cryptocurrencies have the wealth preservation attribute due to limited supply. However, you're most definitely introducing more idiosyncratic risk to your portfolio by investing in cryptocurrencies. But hey, if you're already riding Dogecoin to the moon, why would you care about inflation anyway? On a side note, if you're looking for the next Dogecoin to go to the moon with, and also something with real, serious, future applications, I really think you should check out Sentiment, which is the future of our webs. You saw the picture, I've also included the link to Sentiment in the description below. That's it for today. Hope these are helpful to you. If you like what you hear, or you just like lube, please kindly click the subscribe button. Or let me know in the comments below what your inflation hedge is. Thank you so much for your time, and have a good weekend.